Cash flow and overview. Dear, what are you so busy with?
Damn, as usual this month's budget has gone completely haywire.
Relax. Let's go for deficit financing like the government.
This means my government will have to increase planned expenditure and infuse more money into our economy. Let's get serious, dear. With these skyrocketing prices, my monthly savings have reduced substantially. I wonder, where does all the money go?
You are a student of accountancy. Why do you not apply the principles of the cash flow statement? This would help you to determine the cash that comes in and the cash that goes out.
Good idea.
And in the process, you can explain it to me. I have always wanted to know where all the money goes at the end of the month, but was too scared to ask.
Cash plays a very important role in the economic life of a business. A firm needs cash to make payments to its suppliers, to incur day-to-day expenses, and to pay salaries, wages, interest, and dividends, etc. In fact, cash is the essence of a business enterprise. It is very essential for a business to maintain an adequate balance of cash as per its requirements. For example, a concern may be operating profitably, but if it does not have sufficient cash balance to pay dividends at a scheduled date, it would send wrong signals to the shareholders as well as investors. At the same time, having a lot of cash in the bank does not necessarily make good business sense. Thus, management of cash is very essential. Accounting Standard 3 or AS3, issued by the Institute of Chartered Accountants of India or the ICAI, deals with the preparation and presentation of cash flow statement. The revised AS3 has made it mandatory for all listed companies to prepare and present a cash flow statement along with other financial statements on an annual basis. Now let me explain. What is a cash flow statement? A cash flow statement may be defined as a summary of receipts and disbursements of cash during a specific period. It also explains reasons for the changes in cash position of the firm.
Can you elaborate the concept? I'm still confused.
Cash flows are cash inflows and cash outflows. Transactions which increase the cash position of a firm are called as inflows of cash. Transactions which decrease the cash position are called as outflows of cash. Cash flow statement traces the various sources which bring cash into the business, such as cash from operating activities, sales of current and fixed assets, issue of share capital and debentures, etc. Cash flow statement also traces the various sources which cause outflow of cash, such as loss from business operations, purchase of current and fixed assets, redemption of debentures, preference shares and other long-term debt for cash. In short, a cash flow statement shows the cash receipts and disbursements during a certain period. The objectives of a cash flow statement. Cash flow statement aims at highlighting the cash generated from operating activities. Cash flow statement helps in planning the repayment of loan schedule and replacement of fixed assets, etc. Cash is the center of all financial decisions. It is used as the basis for the projection of future investing and financing plans of the enterprise. Cash flow statement helps to ascertain the liquid position of the firm in a better manner. Banks and financial institutions mostly prefer cash flow statement to analyze liquidity of the borrowing firm. Cash flow statement helps in efficient and effective management of cash. The management generally looks into cash flow statements to understand the internally generated cash which is best utilized for payment of dividends. Cash and relevant terms as per AS3 revised issued by the Accounting Standards Board. A. Cash fund. Cash fund includes cash in hand, demand deposits with banks, and cash equivalents. B. Cash equivalents are short-term, highly liquid investments readily convertible into cash and which are subject to insignificant risk of changes in values. Cash equivalents refer to such investments that are held for the purpose of meeting short-term cash commitments rather than for investments or other purposes. An investment can qualify as cash equivalent only when it has a short maturity of, say, 3 months or less from the date of acquisition. Investments in shares are excluded from cash equivalents unless they are in substantial cash equivalents. For instance, preference shares of a company acquired shortly before their specific redemption date, provided there is only insignificant risk of failure of the company to repay the amount at maturity. Similarly, short-term marketable securities which can be readily converted into cash are treated as cash equivalents. Cash flows implies movement of cash in and out of non-cash items. Receipt of cash from a non-cash item is termed as cash inflow, while cash payment in respect of such items as cash outflow. For example, purchase of machinery by paying cash is cash outflow, while sale proceeds received from sale of machinery is cash inflow. Other examples of cash flows include collection of cash from debtors, payment to creditors, payment to employees, receipt of dividend, interest payments, etc. As per AS3, cash flow excludes movements between items that constitute cash or cash equivalents because these components are part of the cash management of an enterprise rather than part of its operating, investing or financing activities. Cash management includes the investment of excess cash in cash equivalents. Hence, purchase of marketable securities or short-term investments which constitutes cash equivalents are not considered while preparing cash flow statement. Cash flows are inflows and outflows of cash and cash equivalents. The statement of cash flow shows 3 main categories of cash inflows and cash outflows, namely operating, investing and financing activities. Operating activities are the principal revenue generating activities of the enterprise. Investing activities include the acquisition and disposal of long-term assets and other investments not included in cash equivalents. Financing activities are activities that result in change in the size and composition of the owner's capital, including preference share capital in the case of a company and borrowings of the enterprise. Benefits of a cash flow statement. Cash flow statement provides the following benefits. A cash flow statement, when used along with other financial statements, provides information that enables users to evaluate changes in net assets of an enterprise, its financial structure, including its liquidity and solvency, and its ability to affect the amounts and timings of cash flows in order to adapt to changing circumstances and opportunities. Cash flow information is useful in assessing the ability of the enterprise to generate cash and cash equivalents and enables users to develop models to assess and compare the present value of the future cash flows of different enterprises. It also enables comparison of operating performance by different enterprises. This is because it eliminates the effects of using different accounting treatments for the same transactions and events. Historical cash flow information is often used as an indicator of the amount, timing and certainty of future cash flows. It also examines the relationship between profitability and net cash flow and impact of changing prices. To summarize, cash is the oxygen that enables a business to survive and prosper. It is the primary indicator of business health. While a business can survive for a short time without sales or profits, without cash, it will die. It is for this reason the inflow and outflow of cash need careful monitoring and management.
So, this is what cash flow is all about. I always wondered about the cash outflows at our place, but was too scared to ask you.
As soon as I figure out the cash inflows at our place, I'll explain everything.